Now let's get to another interview in our series celebrating the 10th anniversary of Future Generation. Matthew Kidman and the team at Centennial Asset Management have been managing funds on behalf of Future Gen for a decade. So to help mark the anniversary, I sat down with Matthew Kidman and began by asking how he first got involved, and no big surprise, Geoff Wilson from Wilson Asset Management was involved.
I used to work with Geoff Wilson, who was the founder and the person who put the whole thing together, along with a few others. And I'd left working for Wilson Asset Management, but wasn't working for anyone else. I was just managing my own money. And Geoff said to me, I need people on the investment committee. Can you come along and sit on the investment committee? And I said, yeah, fine. Because most of the people we've approached, who's going to manage it, he'd organised it all. And I said, that should be fun. There was Geoff, Gabriel Radminski and myself. And I knew the other two really well. So I thought, it's a good way to keep in touch with people. A year later, I started with a few other guys, Centennial Asset Management. And Geoff said to me, well, now that you manage money, Gabriel and I are both conflicted. We are on the committee and manage money. You're going to have to manage it too. We've all got to be conflicted. So Centennial ended up being one of the earlier managers. And we've been there 9 of the 10 years, and I've been on the committee virtually the 10 years.
Wonderful. So how have you seen Future Gen evolve through the years?
Unbelievably. So I'll look at it from the investment committee perspective. As I said, Geoff put together that it's not as easy as you've got to find the not-for-profits, you've got to find boards, but you've got to find the people who will manage the money and the fund managers, and that's not easy. And you've got to find capacity. So you raise the money, that's always hard, raising money from the public, and they became the shareholders. This is the domestic one we're talking about, and the international one followed soon afterwards. But then you've got to find the managers and how much they're going to let you invest. So that has evolved quite a lot, and the management capacity has built out, and we now think we've got a fantastic group of managers that cover the whole range of domestic assets, from large cap in the equity market to small cap, and obviously different strategies that fit in that. And we've got ranging, depending on however many we need at any one time, somewhere close to 20 managers, which we're one of, which is great. So that's that side. So we've got a terrific list of people that manage the money, and a lot of people you can't get access to. But also the actual investment committee I was telling you about, the 3 of us, we didn't really know what we were doing too well, but we knew the industry, but we'd never been on an investment committee. That's built up now, and it's as good as any investment committee you're going to find in any institutional grade fund in Australia. So there's I think 7 or 8 members now. The original 3 are still there, but the other members that have come on have got depth of experience, knowledge that I couldn't dream of. And so we've got a terrific committee. So I've seen that grow. So the robustness of the business itself, those internal dynamics, are light years ahead of what they were.
Yeah, and that investment committee, when you meet, I must admit I'd love to be there. It must be a very lively discussion.
Yeah, we do. We have discussions, and everyone's under review. Most of the managers have performed really well. We've had to switch out a few over the years because the strategy hasn't worked in the environment and so on. And we get really good data now. We've built that data bank out about what the manager's doing, the underlying assets, how it overlaps with each manager. So we have a lot of interesting conversations, and occasionally there's a bit of debate about how the world should spin, and that works as well. Everyone likes to listen to what the other people, because everyone's got something to bring to the table. And so I look forward to the quarterly investment committee meetings and enjoy seeing the people.
Yeah, okay, so how is the world spinning in your view? First of all, just for those unaware, what is Centennial Asset Management's investment strategy? What do you bring to the table?
Yeah, we're primarily small cap Australian, but we can be all caps, but we concentrate on small caps. We think that's where you find the best value or best opportunities in the market. And we've kept a fairly tight lid on how big we want to be, because all our money, and when I say us, we've got 4 of us now, and we've all got our money in the fund next to the investors, and all our money that's not in our homes, it sit in the fund. So we manage it as if it's almost our own money. And we keep it at a restricted size to try and perform at a certain level every year. And that's what we do. So we don't follow an index. Even though we do small companies in Australia and New Zealand, we don't follow the small ordinaries. We don't follow the all ordinaries. We build a 40 to 45 company portfolio from ground up. And that can be companies. I think the smallest one a couple of weeks ago was $20 odd million, and it can go right up to we can invest in CBA or BHP. But the large majority of the names sit outside the top 100. So they're those smaller cap names.
Really interesting, because 20 million is micro.
Micro.
You know, micro.
That's right. So I kept quoting, we had an investment in a company called SKS Technologies that we went in at $35 million, and it's worked, so I'll tell you about it. And it's grown quite a lot. They do commercial electrical work, and there's been a boom in data centres. They operate in that. So now it's over 100 million. But I kept telling that story for about 6 months, but then we went into a $20 million company, and now it's closer to 40. So, but you've got to be small at that end. But we can go through to the big end, but most of our companies, 5, 6, 7, 800 million range, very broad. We're generalists, so we see a lot of different industries.
You're not going to tell me that $20 million company that's
become
40 million, are you?
Yeah, it's called QuickFee. And it's had a stop-start, QFE's the code. It's
accounting technology that they've tried to run out in the United States as well, correct?
Correct, yeah. And they thought that they could, they were very established in Australia. They were lending money to lawyers and accountants because they've obviously got work that they're doing work for but haven't been paid yet. And so there's money to be lent there for their cash flow issues. And they thought they could do the same in the US where they've concentrated on accounting. Took a while, didn't quite have the right strategy, stop, start, reset, new management. Now they look like they've got the right strategy. So yeah, it's an option whether it works. So far, it's been pretty good. It's ticking up. It's hitting profitability, which is always a nice sign.
Yeah, that's it. Okay, so thank you for that. How is the world spinning in your view heading into 2025? We don't have to talk about the big risk that we're facing this week in the United States with the election, but there's a lot of optimism now around the small end of the market. And do you see that playing out significantly when we get into the new year?
Yeah, I think so. I think we're in a period now. We're at the back end of a multi-year since 2009 bull market. That can last quite a while. The US bottomed in October 2022. It took their small cap index probably a year later to bottom, and the Australian market was probably in lockstep with that small cap index. They're ahead in their interest rate cycles, but they'll lead us, that's good. While the Americans are a year ahead, it gives us a great guide where the world's heading in terms of the financial markets. And so we bottomed in small caps probably a year ago, just over a year ago in October. And I think that will last quite a few years because even though interest rates are a bit sticky and inflation's a bit sticky, they're generally topped out and on the way down. Might take a while, but that will elongate the cycle. And the economies are reasonably good. They're not bombed out. I mean, you always hear a lot of complaining. So people are more optimistic, as you said, than they were. It wouldn't be hard. A year ago in October, it was like, why would you ever invest in equities again? We're past that negativity. We've become mildly positive. But you still get a lot of people say the market's expensive. What are the opportunities? Is it now the right time? You hear that in every market. And I think the next 2 to 3 years will be pretty good. Beyond that, I think it becomes a lot harder, but I think there's a really good opportunity and it will spread as the economies pick up. So I think there's 3 cycles while you're cutting rates. There's the structural growth period where rates are coming off, and so valuations of those premium companies that look expensive, but you can justify paying more. You remember what it was like in 2021? What was the term we used? Growth at any cost?
Yeah.
We're not quite going back there, but those structural growth stories that grow regardless of economies, they'll perform early on. I think they are now. Then you should get to the structural growth, to the cyclical growth stories that benefit from a domestic economy picking up. And then eventually you'll get to resources. Typically they're late cycle and the world's growing quite nicely. So the world is cutting rates and we should get there. And in fact, resources tend to grow when the interest rate cycle turns up a bit. Mm-hmm. That's normally how the different sectors work. So we're still in that structural growth, I think, at the moment. We're early stages.